Good morning and welcome everybody. I'd like to welcome you to this Market Vision 2020 mini-series event with David Keller, CMT Chief Market Strategist at stockcharts.com. He's got a great event for you today. Better routines mean better decisions. Before we get into that, I do want to just take care of a little administrative work. I want to make sure that everyone is aware that Market Vision 2020 is an online financial conference. It is held all day on Saturday, January 4th, featuring a number of my friends and colleagues over at stockcharts.com. Everybody giving a lot of their take on what's happening as we head into a brand new year and a brand new decade with the market at all-time highs. Really exciting time for the market. I want to make sure that you do know how to register for that event. If you go to EarningsBeats.com, that's EarningsBeats.com. You can go to the top of the page, click on the Market Vision 2020 tab, and there will be a lot of information right there, but you'll be able to click on the registration page and sign up. Today is the last day for early bird registration. It actually was supposed to end yesterday. We did extend it one day because we knew Dave was going to be coming in. A lot of you from Stock Charts are here today to see Dave. We wanted to make sure you had an opportunity to sign up at that discounted rate. So make sure you go to EarningsBeats.com, click on the Market Vision 2020 tab, and then you can just follow along. There'll be a link that will take you to the registration page. All right, it is my pleasure to introduce David Keller, CMT. He is the Chief Market Strategist at stockcharts.com, where he helps investors minimize behavioral biases through technical analysis. He is also President and Chief Strategist at Sierra Alpha Research, LLC, a boutique investment research firm focusing on managing risk through market awareness. He is a past president of the Chartered Market Technician, CMT, Association, and most recently served as a subject matter expert for behavioral finance. David was formerly a managing director of research at Fidelity Investments in Boston, as well as a technical analysis specialist for Bloomberg in New York. Many of you can follow along with his thinking at marketmisbehavior.com, where he explores the relationship between behavioral psychology and the financial markets. First of all, it is a pleasure having you here today. Dave, how are you doing this morning?
I'm well, Tom. Good to hear your voice. Good to be on with you.
Yeah, I always enjoy, when I was doing Market Watchers over at Stock Charts for a while, you'd come on as a guest sometimes. We always had really great shows, so it's always a pleasure to get together. And I remember the first time I heard you speak. It was at ChartCon.
Yeah, that's right.
In 2018, and right afterwards, I remember going up to you and telling you what a great talk it was. I think you just have this gift. No, I'm serious. You really do. You have a gift of communicating, and I think everybody in this room that's watching probably struggles with some sort of behavioral issue and biases in their trading, and I think this is going to be a great presentation for everybody. I do also, you just went out to New York, right?
I did, yeah, last week.
I saw a picture of you on the floor of the New York Stock Exchange. Can you tell everybody a little bit about that?
So it was a fantastic trip. We were there for the week, actually, with the Stock Charts TV crew. Interviewed a number of really prominent analysts and strategists, and then had the pleasure last Thursday morning of spending the morning on the floor of the exchange with Jay Woods, who's one of the executive floor governors. There's one of the top handful of floor brokers, of specialists managing the operation of the floor. And we had such a cool time. There was an IPO going on for Bill.com, so we actually got to see the IPO process live and have him describe what the role of the specialist was, how market making has evolved over the last 20 odd years. Got to see the Buttonwood Agreement, which was the document in 1792 that created the exchange. So it was a memorable morning.
Yeah, I remember. I actually was there one time. My partner and I, John Hopkins and I, we used to do national radio shows, and we actually got to the gallery overlooking the floor of the New York Stock Exchange, and we did a live radio broadcast from there.
Oh, beautiful.
Yeah, this was probably 2005 or 2006, something like that.
Yeah.
But I just remember it was one of those experiences you never forget. It was such a cool. When everything you do in your world relates around the stock market, and then you're there overlooking, the history of the New York Stock Exchange, it's really a cool feeling.
Well, and I tell you what was really neat about this conversation in particular, because I know we've all thought about how the markets have become much more computer driven and thinking about high frequency trading and what's the role of humans in a market that has evolved that much. And he was able to answer that question really well. And it focuses on certain parts of the day, the opening price. He is literally setting the opening price based on supply and demand. The closing, he's dealing with order imbalances. And during an IPO, it is a very, even with all the computer power we have, it's still a very hands-on, very human process to figure out how to bring a company public, when it comes down to it. So it was very much eye-opening in terms of how humans are still very much involved at points.
Yeah. Well, I can only imagine, because I do a lot of work. A lot of what I try to do is to kind of get a sense of where I think market makers are on a particular security. And so that would be a very interesting conversation for sure. I'd love to hear that sometime.
Absolutely.
Yeah, getting into your presentation today, I know that's why everyone's here, so we want to make sure we get into that. As far as questions go, I just want to let everyone know you can ask Dave questions. I'll monitor those during the presentation, and I'll make sure that I try to get as many of those questions over to Dave as possible, and he'll try to answer your questions. So just wanted to let you know that there is the ability to ask questions. I'll do my best to try to get those to Dave before he wraps up today. So Dave, with that, I'm gonna let you take it away, my friend.
Thank you, Tom, so much. And again, congratulations on the event coming up in January. I'm super excited to be involved with that. And I know, as you do, the fellow speakers, it's a fantastic lineup. So I hope everyone listening is able to join us on January 4th. That's going to be a very, very cool day of insights from some pretty smart people. My background, as I'll get into, is really dealing with investor decision-making. And my history is, as Tom shared in the introduction, has been, mainly working with institutional investors. So, I just have the logos here so you can sort of see where my history is at relative to the S&P 500. So I started at Bloomberg and worked with institutional investors, helping them understand or incorporate technical analysis into their decision-making. So found a lot of investors that had a very loose, investment process, a lot of anecdotal sorts of things, trading on feel sorts of stuff. And I would help sort of fill in some of the blanks in terms of giving structure to the decision-making process. When you actually make the buy or sell decision, what are the inputs that you're looking at? And then the second leg of my career here was during Fidelity years, where I went up to Boston and ran the technical research department that included the Fidelity chart room, which was a really amazing visual repository of market history and of technical analysis. And I worked with our equity portfolio managers. So I had a team of about 13 analysts in technical research, and we would recommend buy and sell decisions on individual stocks for all of the equity portfolio managers, about 900 billion in assets that they managed. And that was a very much an eye-opener in terms of large funds and the challenges that you face trying to manage that sort of capital. And then I was the president of the MTA at the time, now the CMT Association, from 2010 to 2014, which really gave me, I would say, more of a global perspective. So I spent a lot of time talking with our members outside of the US and thinking about, what a global organization means and what operating in the US versus India versus South America versus Hong Kong, means for an organization. I will try to not dwell on the fact that at this point in my career, I was getting pretty depressed because every time I changed jobs, we seemed to enter a cyclical bear market. So hopefully that trend has changed. We are in a new world, hopefully, according to my patterns here. I launched Sierra Alpha Research, which is my own firm, here in late 2017, really to work with institutions, but ended up being more financial advisors. So helping them sort of address their behavioral challenges. I found with my work with portfolio managers, there was a lot of discussion about decision-making and the behavioral biases that were getting in the way of their decisions. And so launched a consulting research firm to help advisors deal with those challenges as well. And then was hired by stockcharts.com to be the chief market strategist just a couple months ago. Involved a relocation up to the Seattle area. We're in Redmond, Washington now. And so far it's been fantastic. And along the way, getting to work with guys like Tom Boley have been certainly highlights of what I've been able to do.
Hey, Dave, I didn't realize that you started these bear markets. So literally, I just sent a sell alert to all of our members that are in.
I cautioned Chip Anderson here at Stock Charts. I'm like, listen, here's what's happened so far when I've been switching. So just heads up, we're going to have some anxious clients potentially.
That's funny.
Yeah, it's brutal, brutal. So what I wanted to do today, and Tom and I talked about what sort of information, what sort of insights to share. And again, what I've enjoyed the most about my time in the financial industry has been helping investors make better decisions. And I have found, and I will tell you, anyone listening, if you're managing your own account, if you're managing clients' money, even if you're managing a large fund, regardless of how many zeros there are in the accounts that you're managing, you are facing the same behavioral challenges across the board. And I have worked with novice investors right out of college, just trying to manage, a blossoming retirement account. I've dealt with people managing hundreds of billions of dollars. And I will tell you that the same challenges you have behaviorally affect all investors. And having been someone who has taught behavioral finance at the college level, I would love to tell you, if you learn enough about it, that you will not fall victim to the challenges, but it's not the case. I think no matter where you're at, there are always things that you have to check. And so what I've found is the way that I help address that is by developing good routines. And the better you can stick to a good routine, the less the chance that some of these behavioral challenges are going to get in the way of your decisions. So it all starts, I think, with a process like this. It starts with self-awareness. And there is a reason why any 12-step program usually starts with some sort of admission that you are having a problem, right? You have to admit that you are not perfect and that something's going on. Otherwise, it's hard to really address that issue. And so you really, as an investor, have to look in the mirror a little bit and review your own decision-making and lay it out in the mirror so we all can see it, and have an open and honest conversation with yourself about where you could probably upgrade what you're doing. There's this bravado, there's this overconfidence that comes with a lot of certainly professional investors, where you feel like you are unstoppable and you've got it figured out, especially when you have a good run and you feel like you're picking stocks well, or you're picking entry and exit points well. And then don't look now, but a very humbling experience is probably right around the corner. So having an open and honest conversation with you and how you're making decisions is a really crucial first step. So I'd encourage you, if you're not super comfortable with how you make your own decisions, take some time before you, sort of apply what we're talking about here, and really think about what is causing you to get from the very beginning of your day to the point where you're making a buy or sell decision, and really think about where you could maybe upgrade some of those moments. My research firm that I started, as Tom said, is called Sierra Alpha Research, and I've spent some time trying to learn how to fly an airplane. I'm still a student pilot. When my son arrived about 3 years ago, my wife told me I would remain on the ground until she gave me the green light to get back up in the air for time and risk purposes, and I have abided by that. So he's 3, so I'm hoping soon I will unleash myself back into the clouds. But for now, I remain firmly on the ground. But studying flying was really interesting as I thought about applying those lessons back to investing. And I used to chat with my first flight instructor about picking stocks. He was trading on his own account when he wasn't teaching people to fly planes. And so we had a lot of fun sort of comparing the disciplines. And when it came to creating a firm and what to name it, I went with Sierra Alpha, which is slang for situational awareness. And this is the idea when you're flying around an airplane. I'll share a quick story. My first night flight, you're required to have a certain number of hours flying at night, which is kind of disorienting, because on a clear night, you have lights up in the sky in the form of stars. You have lights on the ground. It's hard to find the horizon. So you have to do things a little differently. You need to get used to it. And so you have to have some hours up there. And the first time I went up there, we're sort of flying around, and my instructor next to me says, "All right, do you see anything, going on outside the cockpit you need to be aware of?" And I'm thinking, I don't think so. So I kind of glance around. I'm looking. I'm like, "No, everything seems good." He's like, "All right, you sure around 10:30, 11 o'clock, there's not something you really want to pay attention to?" And so I start sweating a little bit. I kind of peer over, just left of center, and I see some lights kind of getting a little bigger. And I said, "Well, I think that looks like a plane actually around 11 o'clock. He's like, "Yeah, so that's on a collision course with you. So you got about a minute to divert or he's going to hit you." And I'm like, "Okay." So he, of course, just pushes down on the yoke, puts us down about 500 feet pretty quickly. The other plane never budged. It just kept going right overhead. And had we not diverted course, it would have it's very hard to hit another plane in midair, but we would have come dangerously close, uncomfortably close for sure. And it was a great lesson, number one, in why you have an instructor as you're learning to fly an airplane, because you need help. But number two, it was a great reminder of the importance of situational awareness. And that is why the idea that you have to have an awareness of what's happening inside your cockpit and outside your cockpit. And it's so easy to get caught up in the motion, just kind of doing your thing, looking at how beautiful the sunset is, and you forget to have a good awareness. Your livelihood, your existence relies on having an awareness of what's going on around the airplane. So as investors, I find a lot of times we have the blinders on. We don't have a good market awareness or situational awareness for the markets. And so a lot of my work with financial advisors and with investors has been helping to have a better market awareness, improve how they're aware of what's going on in the markets around them. And what I'm going to do today is share some of the routines I use to try to build a good market awareness. I'll share with you one other story in terms of why I named my firm Sierra Alpha Research. I was golfing with my father a couple years ago. We were out on the links a summer morning, getting ready, and my father goes up to a 170-yard par 3 hole, and still at this point, even though I have no excuse for not out driving my father, he still can crush me with the driver, which is a little depressing. I need to do something additional with my hips that I haven't figured out, but I'll get there. But for now, my father continues to drive very well, and so that's probably like a 7-iron stroke for him to get at 170 yards. So he goes and stands up at the tee box, looks that way. And as he's standing there, I remember looking and thinking there's a headwind coming at him, right? So there's a wind coming at you while you're at the tee box. And also the green was elevated. So the green was a little bit higher than the tee box. And so the question is, what happened to his perfectly stroked 7-iron that should have hit about 170 yards? Well, the answer is the ball fell short a little bit, right? Because you had a headwind that held up the ball a little bit when it was up in the air. And also you have an elevated green, which means you don't have as much distance, right? It's not going to get as far as it normally would. So what happened is my dad had the right tools, he had the right toolkit, he had the right idea, but didn't have enough of a market awareness of what was going on around him. And that was another really good lesson about the importance of not just having a good set of tools, but having a really good awareness of what's happening around you as an investor, not just your portfolio, but what's happening in the broader markets. Because I find a lot of investors leave some of their best opportunities on the table. So that's sort of the introduction in terms of why I think market awareness is pretty valuable. And I think what I would like to share with you is my own process for keeping a good market awareness. And I would start by telling you that the most important thing of anything we're going to talk about is consistency. Even if you don't have a great routine for reviewing charts, do it consistently and stick with it. Because over a process of doing the same thing with a regular repetition, that's where you're going to identify where there are weaknesses in your routine. That's where you're going to find when there's places when you could upgrade or downgrade your process. And if you don't do that, I think you're running into trouble, because then you're going to start to move things around when you probably unnecessarily, when you should not do so. So I'm sharing with you now my own web browser, and I'm just going to show you how I actually go through my process. And if you look at the drop down that I'm showing you, I have 2 routines that I follow as religiously as possible. The one is what I call the morning coffee routine. And the way I describe this is, what is the very first thing that you look at in the morning? When you fire up your computer, you get your cup of coffee, hopefully you've showered, gotten ready. Now you're ready to look at the markets and sort of get going. What's the very first thing that you look at? And I would tell you, I found with a lot of investors, they're looking at the wrong thing. And what happens is that very first thing you look at is priming your brain for a certain type of investing. It's priming you for a certain time horizon. And if you do it incorrectly, you're going to be digging out of sort of a mental hole. You're going to have some mental baggage that's going to get in the way of some of your decisions. So I want to talk in particularly about the first couple of things that you look at. That's part of my morning coffee routine that I try to do every morning first thing. And then I also have a weekly process that I usually do some on Friday, and then I do some on Sunday as well. And that is my weekly process of taking a step back when the market's closed, sort of going through and making sure I'm comfortable with where all the data points are at. And by sticking with a good daily routine, a morning coffee routine, and then also with a weekly routine, I find I'm not missing much as an investor. Before I did this consistently, someone would say, hey, have you seen Cheesecake Factory or IBM or Western Dig? And I'd go, what? And then I'd bring up the chart and I'm like, oh crap, I had no idea that stock was doing that. And it's because I didn't have a consistent way of going through all the charts that are interesting to me that I wanted to follow. So what I'll do here is I've opened up actually on a series of tabs my morning coffee routine. I'll go quickly through each of these just so you can see how my brain works. This is not your routine. So I will caution you by saying I do not have the holy grail. I do not have your answer. I'm sharing with you my answer, which comes after 19 years of kind of tweaking this. I'm going to keep tweaking this going forward as I sort of learn new things and as the markets change and volatility changes, and I need to adapt just like we all do. You are welcome to steal this as your starting point, but I would encourage you to not have this be your ending point. You've got to sort of develop your own routine over time. And the more that you make it your own, the more likely you are to make it a consistent thing. If you just use mine, it'll be good for a little bit, and then you're going to move on to something else. Make it your own, make it personal, and then you're going to find it much easier to stick with. So this is what I actually try to do every morning. I did this a little earlier before the session started here today, and this is how I do it. I start with a long-term weekly chart of the S&P 500. So I'm looking at the last 7 years of trading, and I'm looking at weekly price bars, and I'm looking at the 40-week moving average, which is very similar to the 200-day, and I have the 150-week moving averages, and that's it. The reason why I start with this is because for my own investments and also for stock charts customers that I work with, we're long-term investors on average. And that means I need to have a good long-term orientation. One of the worst things that you can do is do anything related to short-term market movements. If you start with, Twitter, or if you start with an intraday chart looking at the last couple minutes, or you look at just the movements and what's up and what's down on the day, you are automatically, I would argue, gearing yourself to the short term. And one of the worst fouls of a long-term investor is to make long-term decisions based on short-term data. So what I like to do is start with a long-term orientation. This long-term chart, the 7-year weekly chart of the S&P 500, shows me by definition that the market is in a raging uptrend. And that's not an opinion, that is not a subjective call. It is an objective analysis of the chart. An uptrend, according to Charles Dow, is a series of higher highs and higher lows. We have continued to be plowing into higher highs and higher lows now for the last year and a half. And so there is no denying that the market is in an uptrend. So all charts that I look at after this point are starting from this starting point. This is where I'm beginning. And everything else should be, all the other decisions I make today should start with the context of the market is in an uptrend. And here's what I'm thinking about this next chart. So what is my second chart? The second chart is a daily chart of the S&P 500. So now that I get the long-term trend, I've confirmed that it is up by any measure, by price, by moving average, by whatever. Now I'm looking at the short term, maybe the more tactical. And because I'm doing this every morning, I'm just looking at the last couple of days and seeing how the market's starting to evolve. So now that I know we're in an uptrend, what are these day-to-day bars telling me about the context of how this fits into the longer-term trend? Now looking at the S&P 500, again, I can see a consistent pattern of new highs. I can see for the last 2 weeks straight, essentially, we've sort of been going directionally upwards. After that gap down a couple weeks ago, but overall, the last week for sure has been incredibly strong. The price is going up above 2 upward sloping moving averages. That is a good uptrend on this tactical time frame as well. So it's pretty much long and strong, fairly attractive market. So is there anything I see on here that would start to get me concerned? So the two things I would look at very quickly is where we're at relative to any key support and resistance levels. So I call this the final bar. That's why my daily closing bell show is called the final bar, because that's the most important one. It's the current price bar. It's the most important, but it's all about the context of where does this fit in relative to where we've come from. At this point, we're at all-time highs. So there's no real barometer here. There's no real resistance level to measure it on. So from a trend following perspective, we need to be assuming further upside. The only thing that concerns me is the fact that we're overbought. And if I look back at when we've become overbought like this, and one of the things that stood out at me is what we're doing right now over the last couple of weeks versus what I saw in July, which was the market went to one further high. We had a lower peak in the RSI, and that led to a pretty good drop there the first week in August. Now, again, overall, the market result higher, absolutely, but there was a little bit of short-term pain. And so that's sort of what's been on my short-term radar is, okay, we've become overbought again. Usually that means at some point we're gonna have a little bit of a corrective move to digest the recent gains. That's what I would expect here. But overall, the long-term trend remains firmly positive. So if you think about it, again, I would ask you to think yourself, what are the first couple things? And again, I'm obviously very technically oriented. I'm looking at charts a lot. And I'm assuming if you're listening here, you're pretty oriented to the charts in some way in your own process. So what are the first couple things that you look at? And I bet sometimes you're looking at things that aren't in agreement with the answers you're trying to come up with or the way you're trying to win this game. So I would encourage you to think about those first couple things and why they might be most important to you. I'll go quickly through the rest of this this morning routine just so you can see sort of what I do. I then go through, I have a series of market trend models. These are very simplistic models based on long-term exponential moving averages. And I usually use the 21 and 34 week exponential moving averages. Those are what I've come to use over my career. But again, there may be other things that you pay attention to, that's fine. But for me, it's just a systematic way of looking across markets and seeing where they're at. So I'm looking at the S&P 500, and then I'm going down here to mid-cap stocks. I'm going to small cap stocks, to micro cap stocks. And if you can see what I'm doing at the bottom here is I'm using what's called the PPO, which is the percentage price oscillator, which is essentially looking at the MACD. It's looking at the difference between two exponential moving averages, for me, the 21 and 34 week exponential averages. And as long as this is above zero, the primary trend on this chart is positive. If it's below zero, that means it's negative. So most of the things I just showed you all have turned positive in the last couple months. Microcaps were the last to turn positive just in the last couple weeks. So overall, all of these, based on these long-term moving averages, are in a pretty positive long-term trend. Then I start looking at what on stock charts we call candle glance pages, which is essentially just little thumbnail sort of images. And what I like to do is take a 30,000 foot view to sort of take a step back and review where all these patterns are at. So here I'm looking at broad equity market indexes. So the S&P, the NASDAQ composite, the NYSE composite, the Dow transports. So this is one of the first places I look at Dow theory, which is looking at the industrials and the transports and whether or not they're in agreement, whether they're confirming one another. And then you can see as you glance down through some of these tickers, you may know it's just different market cap things. It's looking at the value line index, all these different sort of ways that we can slice the broad equity market. And what strikes me looking across all of these thumbnails is that they're all going up and to the right, pretty much without exception. Maybe transports have been the only that's been a little bit weak, but boy, all of a sudden airlines start looking attractive again, and the chart starts to look more positive than negative. So that's where we're at there. The next thing I look at are global ETFs. So now I'm looking at the US, developed global stocks, emerging markets, frontier markets, and then a series of individual country indexes, sort of the most liquid, most popular ones. And I sent a tweet out a couple days ago just showing that looking at this particular layout, essentially most of these are hitting new highs, right? Or at or near new highs. And there's China down here, the FXI and the MCHI. There's Hong Kong, which is, Hong Kong is maybe the least attractive, and it still doesn't look that bad. It's actually testing the 200-day moving average as we speak. So overall, global markets are certainly in bull market territory across the board. Now I'm looking at intermarket analysis. So now I'm looking at stocks versus commodities versus interest rates, trying to just make sense of where equities are, which is where I primarily am interested in, how it relates to other global assets. So, a lot of questions I've had recently are on gold, on the dollar. When the dollar weakens, you tend to have outperformance from non-US markets versus US markets. So that chart of the UUP is one that I think is really, really interesting, sort of testing support at the moment. So we'll see if that holds, or if it confirms a rotation to more of a weaker dollar environment, which would just be different than what many of us have been dealing with for the last couple of years. So here I'm sort of looking at stocks versus bonds and other assets. This is where I think it gets really interesting, because I like to look at a series of breadth and sentiment and ratio charts just to understand the big picture. And just in the interest of time, I can't go through every one of these, but I'll just hit a couple on each page and just give you a sense of where they're at. Here I'm looking at market breadth. And one of my favorite ways to look at market breadth is this chart right here, which is the S&P 500 and the percent of S&P stocks that are above their 200-day moving average, the percent that are above their 50-day moving average. What's interesting to me on this chart is that it's remained pretty close to 70% for the last month and a half, which is pretty elevated. There are times in an extended bull market, like here in 2016 and 17, where this has become elevated and remained elevated. But we're getting now up to a pretty extreme measure. Now 4 and 5 S&P names, or just about 80%, are above their 200-day moving averages. The problem there is when that has happened before. It's happened 3 times in the last 5 years. It was here at sort of the end of the summer of 2016. It happened again in February to March of 2017. Then it happened finally here the end of 2017 into 2018. And every one of those led to a market pullback of some substance. Now, each one of those times, the long-term trend resolved higher, which I wouldn't be surprised if that's what we would see, but I'm certainly seeing that we are very extended in a way that historically has led to more of a righting of the ship, more of a pullback to the long-term regression, the long-term trend channel. And so that's kind of what I'm expecting here going into the beginning of next year. So the rest of these charts are all very breadth-oriented, looking at different ways of wrapping up all the individual stocks and seeing how they confirm or deny what I'm seeing on the broad S&P chart. I then have a series of charts looking at sentiment, and one of my favorite is here looking at the AAII bull bear reading. So this is the American Association of Individual Investors, and it's the percent of respondents that are bullish or bearish. And those are the green and red bars that you see here on my chart. And then at the very bottom, I'm looking at the spread between the bullish reading and the bearish reading. I thought what was really interesting a couple weeks ago is the spread between the two was incredibly narrow, which doesn't happen very often. You usually have the swing pretty heavily either to the bullish side or the bearish side, but for the last couple of weeks, all of a sudden it become very narrow, really represented some indecision. And in my opinion, that was sort of the point where the trend was either going to continue on. This was sort of a pause that refreshes before further upside into the, during the seasonally strongest part of the year, or it was telling you that there's indecision, meaning that people aren't as bearish as they were, and maybe this is an indication that there might be some sort of change. But if you look what's happened in the last 2 weeks, is we've completely resolved to the upside. The indecision resolved with bulls taking control for a lot of reasons, but overall the spread back to more of a healthy bullish configuration and nowhere near overextended where it has been at previous market tops. I then look at a series of ratio charts, and I'm just kind of picking one from each of these lists to share with you. One of the things I like to look at is the ratio of performance of consumer discretionary stocks versus consumer staples. So the XLY over the XLP. And what's happened here is this has been in a downtrend pretty much for the last 6 months. I could extend this trend line and show we're still below that trend overall, just showing that consumer staples, broadly speaking, have been outperforming consumer discretionary over that period. Now, the challenge with that is Amazon is a huge weight in the XLY. It's like 20% or something. So Amazon has been a little chart challenged recently, and that's what's held the XLY maybe lower than you might expect. So here we're looking at actually the equal weighted ETFs, the RCD, which is the equal weighted consumer discretionary, and the RHS, which is equal weighted consumer staples. Here you can see they've actually been moving in lockstep for the last couple months. So they consumer discretionary underperformed over the summer, but then in the fall months, it's sort of been sideways. It's sort of been even Steven. And if you look day to day, you'll notice a lot of times on the daily sector reports that they're pretty much together. They're not much different, the XLY and the XLP, and that's certainly what the chart suggests there. I then look at Julius de Kempener's relative rotation graph. I've used his RRG charts for years. I first met Julius when he was a publishing broker at a sell-side firm in Europe, and we enjoyed taking his RRG charts and actually asked him to send us a screenshot of it every week. And every Friday we'd take a screenshot and we would make a big PDF and we'd stack up all of those relative rotation graphs so we could put the chart in motion and hit fast forward and actually see how the sectors were rotating around the benchmark. And now on stock charts, it's been built into the platform, so you can actually move the S&P forward. You can see how the 11 S&P sectors are rotating around the S&P 500 in the middle. And again, Julius is much better equipped than I am to explain this. But what I'm most interested in is this broad rotation on the weekly rotation RRG charts away from defensive. So you had XLU, the XLRE, Utes in real estate, which had done very well, sort of a yield play and income play for investors. But at this point, it's rotated away and more into technology and financials. The charts have certainly played that out. Here, very quickly, to wrap up my daily, my morning coffee routine, I look at the S&P sector charts. I'm looking at industry indexes, so breaking it down a little further. So, networkers versus computer hardware versus semiconductors. So trying to break down some themes. And the one that jumps off the page at me is airlines, the XAL. And this is a group that has been such a dog at times and people forget about them. And all of a sudden, just in the last couple months, you've had this nice pullback to the 50-day and a potential resumption of the upside with stocks like Delta and others. So an interesting group if you're not there, if you haven't looked at them in a while. Then here's factor ETFs, looking at momentum versus value, other themes. I'm then looking at the Dow 30 stocks just to see visually, are there any big names that are going to drive the markets today and sort of where they're at. And then this is a demo list, but I actually have my own brokerage stocks that I will look at in here for my personal account. So it's worth noting, and this is something to jot down hopefully, please note that my brokerage, my own investments are at the very end of the process. I found a lot of people put the brokerage, put their personal accounts right up here at the front. That is not a good way to start your day, friends, because what you will do is you will immediately key in on a losing position and you will start internalizing that sensation. And that's what's going to drive some of your decisions. You want to do all the analysis first. You want to have a good, pure read on what's happening in the markets, understand the market environment, then look at your positioning and see, okay, here's what I think of the markets. Here's how am I positioned. Are those in agreement? And if you get to this point and you find, well, hold on a second, I'm pretty bullish, but I'm making some really defensive bets in my portfolio, then maybe you need to reallocate, maybe you need to make some changes. But I found for a lot of my advisor clients, we immediately push the brokerage or their client accounts obviously would be in this point first. You move them to the end of the morning routine because you don't want to start with a losing position and have that be what's clouding your analysis. That's where confirmation bias and some ugly things start to creep up. After doing all of those things, I have then earned the right to look at what's happening in the S&P 500 right now. And so this is the chart I'll usually leave up during the open just to see how things kind of open up. And I look at the last 5 days just to see where today relates to the rest of the week or the last 5 days. Gives you a short-term trajectory. But again, that's after I've done the long-term work at the very beginning. And then I wrap up my daily routine. And this is where I sort of park my browser is on the member dashboard on Stock Charts, which is the way you can just follow what's happening. You can drill into our scooter rankings, which is our proprietary technical rating system, and start to really dig into the themes that are evolving during the day. So that is a quick run through sort of my routine. And this is what I do every morning. I start on the left and I open these browser tabs and I kind of go left to right. Again, you are welcome to take some of the things that I've shown you and turn it into your own morning routine. I would caution you though, do not stop there because then you will not stick with it. I stick with this routine because it's my own that I've been tweaking, every week, every month for years and years, and I've gotten to this point. The best thing you can do is sort of create your own routine. Now, the last thing I will show you in terms of my routines is looking at the weekly review. So I do some of this on Friday. So when I'm preparing for my Friday show, I do a session every Friday called Wrap the Week, where we spend about 8 to 10 minutes sort of digging out the big themes of the week. What's happened from a technical perspective that you need to be aware of. And so for me, this routine of looking at these tabs, and a lot of these are the same tabs you saw before, but I open it up as a weekly routine and I go through each of them. And that's the way to just process what's happened and digest it. The last couple of things here at the bottom are things that I do over the weekend. And this is the way that I try to dig into some longer term things. So I'll show you this as well. So this is what I tend to do over the weekend, a lot of times like on a Sunday evening as I'm sort of getting ready. The first thing I like to do is look at industries. And even though I'm now pretty comfortable with where the sectors have moved and I get a sense of the long-term trend, I want to dig a little more into the industry themes. So I'll do a couple things. This is an industry summary page on Stock Charts, and I sort each sector by their technical rating. So I'm seeing strongest to weakest according to a pretty simplistic trend following system. And so I can see within each sector what's working and what isn't, because this is based on, geared more toward the long-term trend, but also looking at the short-term trend. So by going through each of these sectors just visually and seeing what they're at, and I can go to the individual charts or stocks if I want to, I can get a sense of what's working and what's not in each sector. Then what I'll do is I'll run what's called the scooter reports. So what I'll do here is I'll look at US ETFs, and I'm now looking at the 1 week change, and I'll see what's been up the most over the last week, what's been down the most over the last week. And I'll drill into some of these charts on the top and the bottom just to visually sort of process what I'm seeing, what's evolved. And here I'm doing it on ETFs. I'll also do it on US industries. And then I'll finish with large cap stocks and get a sense of individual names, what themes I can tease out. One of the things that I saw just yesterday, and I don't know if this is going to be the same, it is. So this is our ranking of all large cap stocks in the US, and it's in order of the strongest to weakest based on their performance. So it's a percentile ranking. And what's interesting is the top 5 stocks in our rating system are all semiconductor names, which is incredibly unusual. But if you know semiconductors, that tends to be a really good barometer for the overall market environment. Semiconductors tend to do well when the market is doing well. They tend to underperform when the market's struggling. So the fact that the top 5 stocks out of the entire large cap universe are semiconductors is very much a bullish market read. The very last thing I'll do, and this is sort of my Sunday evening routine, is I'll literally go through the 500 odd S&P 500 names from top to bottom, and I do it by sector. So I start with communication services, and I do it by group. So I start with the fixed telecom names, which is AT&T, Verizon, and CenturyLink. And I will literally flip through one chart at a time and just look for any key patterns. And what I like to do is jot down tickers that are interesting to me. I do it incredibly simplistically. I literally do it with pencil and paper on a notepad, and I've been doing that for a while. And for me, that is the way that I visually understand what's happening. And if I have done all of those routines that I just shared with you, from the morning coffee routine every day, that weekly routine on Friday, and then again on Sunday afternoon, I find that I have a really good sense of what's happening, a really good sense of what's driving things, and I'm able to take the blinders off. I have a better market awareness. So I hope this has been interesting. I've really enjoyed sort of sharing some of my routines. And again, I've learned a lot from being able to sit with other investors that have done this longer than I have. And I hope I've been able to just give you a couple ideas of places where maybe you could tweak your own daily and weekly routines. If this sort of thinking is of interest to you, I hope you'll check out my show. So I'm on Stock Charts TV every weekday at 4 o'clock. As Tom mentioned, my show is called The Final Bar, so you're welcome to tune in there. Also on YouTube, I have a channel called Market Misbehavior, where I do some of the things that we've done in this session, but break it into digestible 3 to 5 minute little snippets, just encouraging you to challenge yourself, admit you have some imperfections, and try to address some of those behavioral challenges along the way. And most importantly, if you can look at the tickers on these 6 stocks, my main final message is thank you so much.
That was awesome, Dave. Very, very good presentation. We do have some questions. You have a couple minutes for questions? Okay, let me see if I can summarize these, because we've got a few of them here. One question that came in was they were wondering if these charts that you have, whether or not you have a chart pack over at Stock Charts.
Oh, that is such a good question. The short answer, sadly, is no, I don't. The long answer is, boy, I'm working on it. I'll get one. I will get one set up there. But I will tell you, if you're a Stock Charts member, if there are any individual charts that you found interesting, I'm happy to share them with you. Just shoot me an email and just do it. The final bar at stockcharts.com is a great way. That's the email for my show, and I'm happy to shoot them over to your Stock Charts login.
All right, sounds good. Now the second question that came in, I think the question is basically, I'm going to paraphrase here a little bit, but I think what they're looking for, everyone talks about, buy this, buy that, but they're looking for more guidance in terms of managing and selling positions and examining your overall portfolio metrics, and so what you're holding and so forth. So if you look at your overall portfolio metrics, what do you look at? And is there anything else that I guess that you can share with folks about as far as selling and going through the mental process, I guess, as far as selling positions? Because it's like, yeah. I mean, I've been in this position before. Sometimes you buy a stock and you just think it's the best thing since sliced bread, and it's like a child. It's hard to sell.
Yeah, and there's a behavioral bias for that. It's called the endowment effect, and it's where you become sort of married to your stocks. You treat them as your children. You can't sell one of your kids, right? I mean, so it's you're emotionally connected to this position. And Will Danoff, who's one of the prominent portfolio managers at Fidelity, he always said, remember, you're never buying stocks, you're just renting them. Which now totally, disclaimer, owning stocks, there's a responsibility as a shareholder. This has nothing to do with that. It's more just mentally how to think of it, right? You should be thinking of your positions as renting them, and you should be able to unwind that lease at any point if it's not the right time to own that anymore. Don't think of it as something that you've bought that you are now stuck with, that is a weight around your neck. It's just not the case. So make sure you think of that. So to answer your question, I would say 2 things. Number one, I have found, people, when they learn technical analysis, tend to be really good at buying. That's where they tend to get really good very quickly, because it's super exciting to pick the next home run. It's super fun to pick that stock before it's a 10 bagger and it just goes up. It's good to buy a stock and outperform and feel like you're a hero. It is not sexy to start trimming positions that aren't working anymore. But I would argue that's probably much better for your financial stability, financial health, is looking critically at some of your positions that aren't working anymore. So to answer your question in particular, two things I would do. Number one, I would say if there's a place to get help with your investing, that's certainly one of them. And again, I think a number of the speakers you have at the event in January are all very well equipped to help people understand more of that sell side of the equation. I learned a lot from following analysts that had been doing it longer than I had and seeing what their sell discipline was, because that helped me to, think about what would cause me to exit a position. I really didn't have a good answer until I learned from others that have done it. So it might be a really good idea to check out, some of the speakers and just see how they, look at what they're doing to understand the sell side of the equation, because I found a lot of people just don't pay enough attention to it. The second thing I would do is make sure it's a very disciplined process. So I actually, when I teach new investors how to use technical analysis, it's all based on checklists. So here are the 8 questions that you need to answer before you can tell me whether or not you're bullish or bearish. And for me, it's things like, is the stock in a primary uptrend? Higher highs and higher lows, yes or no? And that's your first answer. And then you go through all these other checklist points based on the chart. But until you've done that, you're not allowed to buy or sell. You're not allowed to have a bullish or bearish opinion because you've not checked those off. You should have a checklist for sells as well. And it should be a very clear list of things. When XYZ happens, when the stock moves down 8% from a high, could be one of those. When the stock breaks the 50-day moving average, when the stock has a 3 ATR move to one direction. I mean, there are a lot of ways that you can do it, but the key is to have it very listed out. So when these things happen, you sell. You don't think maybe I should sell. You don't think maybe I want to reconsider it. You sell. No emotions, no change, I'm out. And if you look at systems like William O'Neill, sort of the Investor's Business Daily CanSlim system, it's a hard and fast like 8% rule. So if stock moves 8% against your position, you sell. And it doesn't matter what you think of the market, of the world, of that stock, you're out. And that just prevents you from having a climactically big loss. So my 2 suggestions: get help from people that have been doing it and see what their sell discipline is. And number 2, make sure that you list it out and follow a script for when you're going to sell. You're going to find that gets you out at times when you probably hold on for emotional reasons.
All right. You did mention the ATR. I just want to let everybody know it's average true range. And if you're not familiar with it, there's great articles over at Chart School at stockcharts.com. So make sure you check that out. Yeah, and I agree. I think you said something earlier too, Dave, that maybe helps to answer that question too. And that's, what kind of an investor are you? If you're a long-term investor and you see your stock going down because it got downgraded today, sometimes the temptation is, I'm going to sell. But I think going back to your routine and saying, okay, is this still within the parameters of what I was expecting longer term? I'm okay with it. Try not to react to news items that come out, daily, if you're more of a longer term investor.
Yeah, the worst thing you can do as a long-term investor is make long-term decisions based on short-term data, and it happens a lot. And especially with news, with earnings, you have a quick gut reaction to what you're seeing, but that checklist keeps you centered, keeps you long-term.
Right. There was another question that came up. I know you showed your exponential moving averages. And the question was, can you repeat those exponential moving averages? What were they and why did you choose those?
Yeah, a good question. So on the weekly charts, my sort of long-term trend following model is the 21 and 34 week exponential moving averages. Exponential averages are a different way of weighting. It's more sensitive, more geared toward the recent price data. So for a long-term average, it works really, really well. And I've used 2 combinations over time: the 13 and 34 week, and Ned Davis, who's runs a pretty decent research shop, calls that the Big Mo model. It's 13 versus 34 week. I use the 21 and 34 week. Those are all Fibonacci numbers. That's probably why I first used that combination. But for me, it was trial and error, and I found that in general kept me in long-term trends, and it doesn't register a sell signal until things really correct enough that you're starting to feel the pain. And so it's a great, when that sell signal triggers, you need to be aware and really in disaster management mode. So that's why I use those 21 and 34 week.
All right. Do you look at anything other than RSI to look at the market, see if it's overbought, overextended? Is RSI it, or is there anything else?
Yeah, good question. And again, I'm sort of simplifying as much as possible just to clarify what I'm trying to do. If I had one thing other than price, RSI would certainly be it. I don't like to overcomplicate it with a lot of other things, even though I've seen people use other techniques with great success. It's just not for me. And probably a lot of that comes from the fact that I've always worked with non-technical analysts. I've worked with fundamental investors and salespeople and analysts. And so I've only been able to use things that I can easily explain to other people and easily justify. So I use things that have added value to my process, that have helped me pick stocks well, and things that I can explain very, very readily. And so the RSI, I think, makes a ton of sense. It's a very simplistic measure of price momentum, but it just works for me. And there are a lot of ways I didn't allude to that I use it beyond what I showed, but it's really the main tool that I use. The only other thing I would tend to use is the MACD indicator, or the PPO, which is more of a trend following device. And I use that. I didn't really show it a ton here, but if you looked on my long-term weekly chart, I also have on my model, I also have the PPO, and that's more of a tactical time frame. So that gives you sort of the short-term, couple weeks to a couple months sort of trend in the S&P. If you look at the weekly MACD, it's pretty good for that.
Yeah, and I would actually add a little bit to that too, because I used to use the MACD and I just switched over to the PPO. And it's really just because if you're looking at two different securities and the prices are a lot different, the MACDs you really can't compare, but the PPOs you can, because it's based on percentage as
That's
opposed
right.
to dollar. And then the other thing that you could do, I think, with the PPO instead of the MACD is if you're looking at something like Apple, and you're trying to compare Apple being overbought using a PPO and comparing it to a prior time in history, you can do that using percentages. But if you use the MACD and Apple is now, $180 a share, but 20 years ago it was $4 a share, the MACD is not going to be comparable. So, I only say this because I do use the PPO and the RSI, similar to you, Dave. Mm-hmm. And when I think that the PPO does give you some pretty good signals, historical signals, as to what is overbought on one particular stock in terms of momentum versus another. So you may have, a utility that's not very volatile. If it gets a PPO of 2 reading, might be overbought for that stock. But then you get a small cap or a micro cap that has can shoot up very quickly, and you might see a PPO shoot up to 15 or 20, which is unusual for a lot of stocks. So it depends a little bit on volatility. That might maybe give a little sense as well of overbought.
Yeah, great points.
Let's see here. Just a couple more questions. There were a lot of questions coming in. We're not going to be able to get to all of them. One question that came in is just about, and this was a question that's been asked multiple times, as far as seeing a recording. This has been great information. I know all of you would like to go back and see a recording. We will absolutely, I think what we're going to do at EarningsBeats, if you go to YouTube, we have an EarningsBeats channel. And I think we are going to go ahead and set something up so that we have a separate channel developed just for these mini-series events like the one Dave did today. So you can check in with our EarningsBeats.com channel over at YouTube, and you should be able to find this later today. So just wanted to let you know that. And if there's anything, if something else happens and we end up having the recording somewhere else, we'll make sure we reach out to everyone to let you know where you can find the link for the recording. A question came in. Do you pay any attention to the volume bars during your processes, your morning coffee routine? Does volume play a role in how you evaluate the market?
Good question, and the short answer is it really does not. I've sort of evolved my toolkit over time, and when I was first learning technical analysis, this was early 2000s, I spent a lot of time looking at volume, and I was at Bloomberg at the time, so we did a lot of work with money flow, which is looking at tick data and looking at volume on upticks and downticks and all that sort of thing. And I just found, and there are a lot of reasons why this has happened. Decimalization really, sort of muddied the waters on money flow a lot in terms of that measure of money flow. So volume in general, I've used less and less. I will look at broad exchange volume at time. That's part of the breadth charts that we didn't get to. There's a couple sort of market volume reads looking at up and down volume and things like that. But on individual names, to be totally honest, I look at it very little. And the reason I would say is, for me, years and years ago, there was if a stock moved and the volume was significant, you could assume, you could make assumptions about directional bets that big institutions were making, because that was the only way that the price and volume would look that certain way. But now I found with, with hedge fund activity and dark pools and there are a lot of things that volume fluctuations can mean, and it's harder to get a pure read. So for me personally, I've not included as much in my process. A lot of technical analysts that I respect a great deal look at volume very regularly, and that's certainly a valid part of their toolkit. For me, it's in a bucket of indicators that I don't use as much as others.
Yeah, that is probably one of the most interesting points of technical analysis. Is some swear by volume and others don't consider it. And people that I respect on both sides, I use volume a lot in my analysis, but I know many others at Stock Charts don't. And I have a tremendous amount of respect for them, but it's just different philosophies, different strategies.
Sure.
Let's see, there's just a couple more questions here. We want to cut this off soon because I know Dave's got to get going. How about books? Someone's asked, could you recommend 3 books that you would say are just must reads based on your background and what you've done? Are there 3 books that you still maybe refer to and use?
Wow. Such an awesome question. I will go a little bit off. I will recommend 2 technical analysis and 2 non-technical analysis books for this one. For technical analysis, I learned technical analysis using the John Murphy book, Technical Analysis of the Financial Markets. Since then, there have been other books that have been written that are very, very good. And the Charlie Kirkpatrick, Julie Dahlquist book is the one I used when I taught a course at Brandeis, which is very, very good. It reads more like a college textbook. In terms of someone was asking me with their teenager, they're trying to help them, use charts and sort of understand the markets and follow some charts and paying attention to them. And I recommended the John Murphy book, which again was the first one I read. I think it stood the test of times in terms of, simplifying and making what we do very accessible. And I think, to be honest, that's one of the great benefits of technical analysis. It was created as a way to simplify a very confusing thing, which is how stocks are trading. So in the early 1900s, charts were the way you could do it. And so I love the simple message of charts. And I think John's work speaks to that very, very well. So that's the first one I'd recommend. Because we talked about self-awareness and about routines, I would say the second book was by Brené Brown. And her first name is Brené, B-R-E-N-E, and her last name is Brown. She wrote a book called The Gifts of Imperfection and talks all about having a self-awareness, having an honest conversation with yourself, recognizing that you're imperfect, and having that be the starting place to growth and success. And I think that's a message that many more people need to hear than have heard it. So that's the second one that I would do. And then the third one I would say is sort of the classic Stephen Covey, 7 Habits of Highly Effective People. I try to read that one every year, and I'm mentioning it because I'm getting ready. That week between Christmas and New Year's is usually a good time to reinvent yourself. And I try to block off that week. I call it a power week, and have a series of things I try to do to just better myself and make the next year better. And I try to reread that book every year during that time. And I always am picking up different things, but in particular, in terms of prioritization and time management and being a good communicator, I've learned more from that book than from anything else. So those would be my 3 random ones.
Okay, awesome. I would definitely second John Murphy's books. I am pretty much a self-taught technician, but I have to admit that I read his books and he has heavily influenced my look at the markets, especially in terms of intermarket analysis and just seeing that when this happens and this happens, this usually happens afterwards. That kind of analysis is something that can just be worth its weight in gold. So I'm a big fan. And of course, as I mentioned earlier, John Murphy is going to be our keynote speaker on Saturday, January 4th. If you haven't listened to John talk about the markets, trust me, it is a treat. And make sure you sign up for the Market Vision 2020 so you can hear his latest as we go into 2020. And there is, I want to mention this, I have one more question for you in just a second, Dave, but I do want to mention to everybody in the room that today is the final day of the early bird special. So if it's something you're really interested in, I would highly recommend you go to EarningsBeats.com, click on the Market Vision 2020 tab at the top, and then go in and register for the event. Make sure you get that special early bird pricing. One last question. and there were a couple of folks asking about options. And number one, do you trade options? And then there was another question asking about the put-call ratio. And I know you talked earlier about that bull-bear ratio, maybe from a sentiment perspective. So number one, do you use options at all in your trading as a hedge or maybe something more aggressive? And number two, do you look at options, the put-call ratio, as a sentiment indicator?
Yeah, great questions. And I would say the short answer is, do I trade options? I don't. That I think is a byproduct of being on the institutional side. When you're at a place like Fidelity, a large firm, you are so restricted in terms of your personal investing that you learn to get completely away from things you can't do. And options were sort of a no-no. So we weren't really allowed to speculate that readily. So I got away from that, and that's when I really started using ETFs, because we were exempted from a group of ETFs that we could trade more actively with less restrictions. So that was my growth in attention and use of ETFs happened during that period. So at some point I certainly should think more about options. I've not done it. And that's comes from I guess my time of being unable to do so. In terms of the put call ratio, I certainly pay attention to it. I didn't get to it on the sentiment side, but just below that chart of the AAII rating, you saw the VIX, good measure of volatility, and then down below there, I have the put call ratio. So it's certainly one of the broad indicators I would use. I think what's interesting about options is I've always found it compelling that you have a secondary market that is tied to the core market that we're looking at. So I've always enjoyed strategists that look at unusual put call volume, especially on individual names. I think there's a good signal there at times, and so yeah, put call ratio I think is a good one to pay attention to. Sure.
All right. Sounds good. Well, I tell you, we've kept you a full hour. I know, you've got a lot of things to do as the chief market strategist at Stock Charts, but I really want to thank you for taking so much time out of your day to come in here. We've gotten so many thank yous in the Q&A. I think this information was so valuable to a lot of people. So first of all, just want to really thank you, Dave. Great presentation.
Absolutely, Tom. No, thanks for including me, and I'll look forward to seeing everyone on January 4th. Should be a really good event.
Yep. So we got John Murphy coming as keynote speaker. Dave's going to be there talking. I'll be talking. A lot of our friends and fellow colleagues at stockcharts.com will be there. Make sure you go to EarningsBeats.com, click on the Market Vision 2020 tab, and register. Today is the end of early bird registration, and we did extend it a day because we knew Dave was coming on board. We knew we had a lot of Stock Charts folks coming in today. So make sure you take advantage of it. Thanks for tuning in, and we will make sure you get access to the recording of this presentation today. So again, thanks, Dave, and thanks to all of you for showing up today. Have a great day.